Welcome to Stu-C TV friends. Today we are going to discuss about liquidity. The concept of liquidity. We will use some ratios in the balance sheet to study the concept of liquidity. This is important from CAIIB exam perspective for your paper 1 ABM module C. So let's start. So we are looking at three ratios, basically two ratios and one concept: current ratio, then quick ratio, and then one concept of net working capital. Okay, let's start. So in this discussion, we will look at three companies: company A, company B, and company C, and find out which is better. So which company is better? By better, I mean we'll look at which will survive in the next 12 months. Which will survive in next 12 months. Out of these three companies, which company has the best position to survive in the next 12 months, whether it can meet its liabilities in the next 12 months? That is the essence of liquidity. Okay. To decide about these companies' survival, we will apply three concepts. First is the concept of net working capital, which is calculated through a simple calculation which says current assets minus current liabilities. Current assets minus current liabilities. This is the formula to find out net working capital. That's the first concept. Second concept, we will use the concept of current ratio, which is a ratio of current assets divided by current liabilities. So that is the second concept we will use. And finally, we will use the concept of quick ratio. Quick ratio is current, just like current assets. Only difference is in the numerator, we will reduce inventories from the current assets. So current assets, includes terms like cash and bank balance, account receivables or debtors, and inventory, etc. So out of these three items I mentioned in current assets, cash, bank balance, receivables, and debtors, these are easily convertible into cash within 12 months. But inventory is not that easily convertible into cash. It takes slightly more time. So we'll exclude inventory for the moment and then calculate the ratio of current assets and current liability, and that is called as quick ratio. Now these three concepts we will discuss. Before calculating ratios, I want all of you to understand a very important concept about balance sheet. Let's start. Actually, I have learned myself this from a book by Dr. Anil Lamba. It's a book called Romancing the Balance Sheet. If you want to know very much in detail about balance sheets, then you can definitely, I recommend to read those books. For me, it was very useful. So I'm recommending that. Now we'll continue our topic. So as you can see here, liabilities and assets. This is essentially balance sheet, and liabilities are source of funds, and assets are application or use of funds. So liability shows where the money comes from, where money comes from for a business, where money comes, and assets show where it is spent, where the money is spent. Okay, where money goes basically. So now we have classified liabilities into two types. They are long term sources. They are sources. One can be long term sources like owners contribution, share capital, reserves, etc., and then long term borrowings from banks. So this will be classified as LTS, long term source. And then next item is short term source, which is basically current liability. So liability side we have LTS and STS. On the asset side, which is use of funds, we have first long-term uses, LTU, like fixed assets, long-term investments, etc. And on next, below that, you have short-term uses, STU. It is basically current assets. So every balance sheet you can classify it into four terms as per Dr. Anil Lamba. So it is LTS, STS on the liability side, and asset side it can be long-term uses and short-term uses, LTU and STU. So this is the summary we just mentioned. Liabilities, you have LTS, long-term sources. These are STS, short-term sources, that is total liability. User side, you have LTU and STU. Long-term users, which is fixed asset, short-term users like current liabilities. So this is the summary. Now let's look at it in detail. LTS means long-term source coming from long-term loans or the business owner's capital. So these funds can be returned a little later. They are not to be repaid immediately. But if you look at short-term sources like current liability, these are short term. That means they have to repay it within 12 months. So how will you repay them within 12 months? Using current assets. Short term uses like current assets. Current assets means bank balance, cash, your debtors, receivables, all those things. You are selling your goods, inventory, converting them into finished products, selling them and getting cash. And that cash you will use to repay these liabilities you have borrowed for short term. So that is the main purpose. And long term sources you normally use for long term uses like purchase of land, building machinery, that will give you return in the long term. And these guys who are giving you money also don't want it immediately, they want it in the longer time, and they are investing for your future. Now let's apply whatever we have learned till now. So we are looking at three companies, company A, B, and C. Their balance sheet you can see here. The total size of the balance sheet is same for all companies. It is 100 assets and 100 liabilities. But the composition of these 100 liabilities and assets on each company varies. Let's see one by one. So we will look at A, B, and C in the next video. We are slightly running out of time. So we'll make part B of this series. And in part B, we will explain how we are applying these concepts in A, B, and C. Wait for part 2 of liquidity.